My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. There are just too many distortions. Everywhere we look, we don't have good comparisons, so we don't know what works and what doesn't. When I was writing my speech for this past weekend CNBC Investing Club annual meeting, I wanted to compare how companies were doing versus previous years, but nothing's working because the comparisons, they just don't fit. Nothing makes sense, and that's causing tremendous havoc in the market. Although today we did get a nice reprieve with the Dow gaining 72 points, S&P advancing 0.31%, NASDAQ climbing 0.63%. I do not know how long it will last. The discrepancies at this moment are just too difficult to fathom. Let me give you some examples of what we're up against, because they offer a real glimpse into the contrary nature of this market and why we worry about what the Fed's worrying about. Notice, we worry about what the Fed's worrying about every darn day. Notice, we aren't concerned about what the Fed's going to do so much as we're perplexed by what the Fed sees and what it doesn't see, because it's so hard to tell with so many of the distortions I'm about to go over with you out there. Now, let's start with the most top of mind. I want to start with the one-year anniversary of a truly catastrophic distortion, Mother Russia's bid to restore the territory of the old Soviet Union, maybe even the old Russian Empire. It's almost unfathomable that Vladimir Putin could really start a massive conventional land war to take over Ukraine. They were supposed to be extinct. The economic distortions from this war and the resulting sanctions are humongous. While the Federal Reserve can't do anything but the food or energy disruptions, they must be worried about what those disruptions mean for inflation for you and for me in our pocketbooks. For example, when Russia invaded Ukraine, 13% of the world's calorie production got taken off the table, and suddenly Russia couldn't sell its voluminous oil supplies to Western buyers, so it jacked up food and energy prices. That inflation filtered through the system, even though it's an artificial distortion. Then President Biden unleashed a huge amount of crude for the Strategic Petroleum Reserve, forcing oil back down to the low 70s. Another distortion. If you want to figure out the real value of the most important commodity in the world, what it would be worth in a basically functional global economy, right now we have no idea. Is it 150? Is it 50? You know the Fed is worried about the former or anything close to it, despite having no control over it. Why don't they say it? They have no control over it. When Russia went to war, wheat spiked because Ukraine's the breadbasket of Europe. Do you know, though, in the last few weeks, we learned Russia's got a bumper crop of wheat? Now wheat's price is plummeting. Does that mean the price in the supermarket will fall soon, too? Who knows? The wheat market is totally distorted, and the reverberations are a nightmare for anyone who's concerned about inflation when it comes to food stuff. Of course, not all distortions are purely negative. We've never in history had an economic slowdown where auto demand was up, way up. Yet that's what we have right now. Some of that's because semiconductor supply chain issues caused a multi-year car shortage, creating a massive backlog of demand. Right now, the demand for cars is so high that steel makers can raise prices sky high. They raised them again today. What's the Fed supposed to do with that kind of distortion? Can't build steel mills. Making things even more tricky, the big auto companies are ramping up electric vehicle production instead of meeting the insatiable demand for regular trucks. They spend fortunes churning out electric versions of the same models. That alone has kept prices high for cars and trucks. From the regular internal combustion engine, it's never happened before, ever. Total distortion. And, of course, there's the hangover from multiple years of federal giveaways, stimulus checks, souped-up child tax credit, and $10,000 in student loan forgiveness, although that's currently being challenged in court. I am extremely sympathetic to student borrowers because higher education has gotten insanely expensive. Have you seen it? It's going to cost 100 G's a year. But this represents a massive infusion of cash into the system, and that is inflationary. For me, the tragedy of Biden's agenda is that this stuff would have been great if they'd done it back in 2009 when Biden was Obama's vice president, and we had the worst economy since the Great Depression. But now the problem is inflation, not deflation. And that demands a different set of solutions that seem to evade this administration's can. Next distortion, housing. Normally, housing is the most hostage to the Fed, correct? But now the Fed raises short rates dramatically, yet somehow mortgage rates don't go up nearly as much as you'd expect. Mortgage rates are supposed to go up initially with the long rate, and then the projections are that they'll go even higher. But then what happened is bond buyers came in and picked up 10-year paper at what I regard as absurdly low levels because they're betting on a recession. That pushes mortgage rates back down. And housing demand made a huge comeback as this happened in a totally wacky January while the Fed's tightening like mad. That's not supposed to happen. Discrepancy. As long as housing prices are going up, how the heck can the Fed not keep tightening? Well, if there's demand, say, for 5 million more homes, courtesy of millennials, starting with families than the housing companies can make, well, the Fed has to take interest rates to ruinous levels to really slow down that. The distortion in housing is even larger than the distortion in autos. You just can't game the price of housing anymore. You can't do it because investors seem unable to stay away from the meager yield they get from 10-year treasuries. It's irrational. A bunch of delusional, self-absorbed investors have been getting slaughtered in the 10 years. Rates go up and prices go down, and it's going to continue to happen. If they walked away, we'd actually get an honest price for where the 10-year would be, and that would actually help combat inflation. I think the Fed is stunned that so many bond buyers want this paper. How could they expect that? Right now, the Fed's busy selling hundreds of billions of dollars of this kind of treasury, and these buyers don't care. It must be driving the Fed nuts that the bond buyers seem insatiable. It's completely distorted by lunatic buyers who don't know what they're doing. Next, we've got the COVID hangovers. People hunkered down and bought way too much stuff for their homes, especially their home office setups. That drove up the price of everything from furniture to booze to personal computers. So all of these companies ramped up production, thinking it's going to last for a long time. But the shortage in furniture and personal computers turned into a glut in about 6 months. Why? Because we got a pair of incredible vaccines out of nowhere, meaning people no longer needed to hunker down. At the same time, millions of people decided to retire and go on vacation because life is too short. No tables in history account for this kind of national movement. The vacations, they are insanely expensive, but nobody seems to complain because life is too short. Airline tickets, hotels, no pushback on price. We've never had anyone embrace the you only live once ethos at the same time. Before the pandemic, few people over the age of 30 thought it like this. How long do we have to go? How long will be the rational distortion of YOLO? If you ask the Fed, it won't have a clue because they can't figure this out. They're going to get interest rates right if they can't figure out YOLO? I could go on and on. When you add up all the distortions they've made, it's insanely hard to predict consumer behavior, which is why the Fed's moves to date seem to have little impact. We don't know when the distortions will end, but there isn't a single thing I've mentioned that could have been predicted, and almost all of them seem surprisingly immune to the Fed's rate hikes. Given that the balance sheets of most companies are strong and private equity firms seem willing to buy almost anything that's hurting, the Fed can't even cause the kind of bankruptcies that you'd expect after a rapid series of rate hikes. The bottom line, nothing in this economy is working like it's supposed to. Nothing is predictable. And history's a terrible guide right now because we've never been in this situation before. Right now, the Fed keeps trying to win the fight against inflation. But it feels a lot like the little Dutch boy trying to plug a dike full of distortions. And the holes make no sense because this dam should have been busted a long time ago. Let's go to Richard in Oregon. Richard!
Hey, Jim. Love your show. Thanks for having me on.
Thank you, Richard. Thank you.
Quick question. You're welcome. Quick question. I'm debating buying some more Ford to add to my portfolio. I like the dividend and would like to know your thoughts on Ford.
Okay, I saw Ford stock acted well today. Ford, I have to tell you, Jim Farley has pretty much guaranteed, he has said it to me, guaranteed that this quarter is going to be the quarter that he does it, that he finally puts the numbers all together. I'm going to bank with Jim Farley, as I do for my charitable trust. Talked about it this weekend at our annual club meeting, and I'm going to say that you can too. Jim, your feet are to the fire. Terry in Washington. Terry.
Hello, Jim.
Terry,
one question and one stock opinion.
Okay.
You always instruct us to do our homework before investing, and I'm doing due diligence on joining the club, but wanted to find out past performance, specifically how it did in 2022, a down year for the averages, and also where can I find a list of the stocks in the trust? And my stock that I'm calling about,
you have to go to the CBC.com.
Holding.
Okay.
The company
all that's
in
at CBC.com. Okay. All of what you just said is at CBC.com. That's where I'll drive you toward. ASMLF is a very good company. They make indispensable equipment, the size of a bus, actually. to be able to make it so that you can have great semiconductors, the highest end, and I like the stock. Let's go to Fulnetti in New York. Fulnetti.
Jimbo, booyah.
Yo, booyah, what's up?
I appreciate you taking my call. I'd like to shout out my older brothers, Igor and Boris, for introducing me to your show 5 years ago, and congratulate my baby sister, a student at Vanderbilt University, for getting accepted into Columbia Law School this morning. We thank you very much for sharing your investment wisdom with us. Jim, I'd like to hear your thoughts about a growth stock that skyrocketed during the pandemic from the 80s to an all-time high of 308 in February of 2021, and then came crashing down through 2021 and all last year. Now in the 20s, and given the recent steam that growth stocks have gained through the start of the year and the possible soft landing to the economy, do you think it is a good time to buy Teladoc and hold for the long term?
I don't want you to buy Teladoc because they're losing a lot of money. You take a company like Zoom Video, they're starting to make a lot of money, and I like that. If you're losing a lot of money, that's Teladoc, and I don't like it. It's pretty straightforward. That's how I feel. Nothing in this economy is working like it's supposed to. And those discrepancies have made it very difficult to fight inflation. On Mad Money tonight, should investors spare no expense on an investment in Bolero? I'm learning more about what sent the stock higher after earnings with the CEO. Then this weekend, Berkshire Hathaway released its annual shareholder letter. I don't think it got enough attention. There's a lot to unpack. I'm revealing what I learned from the letter that I regard as being required reading for any investor. And Tanger Factory Atlas was the top performer in a tough group last year. So what could this year hold? I'm getting the latest from the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.